help you to understand potential pitfalls, and give you hope. More than anything else, though, I want you to protect your future, everything you have worked for, saved for, and plan to enjoy. Retirement is a critical issue, and it involves a broad range of concerns. Here, I've sorted those concerns into 6 areas of discussion that relate to your financial security and emotional well-being. Those areas are how to choose and work with a financial advisor. What are the benefits of trusts as opposed to wills? How to provide for long-term health care. How to handle the shock of an early retirement offer. How to opt for the best pension plan. And finally, how to minimize your expenses and maximize your income. Remember, to keep your money and your retirement safe, you have to take control of your destiny, and I want to help you to do just that. This means that you should view the financial concerns I take up as a part of something bigger, as part of your lifestyle, as part of your family's welfare. Whether you're there already or just on your way, retirement marks a major turning point in life. It is a new beginning, a rejuvenation. It is not a retreat from life or work, as some say. It is a time to look forward. One of the first hurdles is selecting someone to give you solid investment advice. The one thing you must avoid is what I call the guardian angel syndrome. You'll see what I mean from the following story told by a client of mine, Anita.
When my husband died in 1974, I received $10,000 from his GI insurance policy. I know it wasn't much, but I took this money and some money I borrowed from my younger sister and made a down payment on a small house for my son John and me. 4 years later, when I turned 60, I finally retired from my job as a library assistant. Shortly afterward, I received a small inheritance from my older sister's estate. When the money arrived, I decided to invest it because the temptation to spend it would have been too great. I decided to go to a large, well-known brokerage firm nearby. I thought of them because I saw their ad in the newspaper. It pictured a young blonde woman standing in an office doorway. The caption under her picture read, "Guardian Angel," in big letters. And under that it quoted, "I have a lot of retired folks for clients who give me more than just money to invest. They give me their trust." So when I arrived at that company, I asked for a woman broker just like the one in the ad. That's when I met Patty. Patty was totally convincing. She had such a winning way about her. She was so gracious and welcoming, never the least bit insulting. She insisted she would tell me everything I needed to know and would take care of everything. She was reassuring on every level. Patty explained that she and her partner monitored the stocks of some 50 companies and knew exactly where and when to invest and when to pull out. They were on top of things all the time. Additionally, she said that she got a yearly return of 40% to 45% on her personal investments. And even though I couldn't expect as high a return, I could get about 20% to 25%. Well, CDs were up to 14% at the time, so I thought that maybe I could make this much. The only stipulation I had for Patty was that she keep my money safe and sound so I wouldn't lose it. We agreed, and she then gave me blank account forms for my son and me to sign as joint tenants in case of my death. The account was officially opened, and because I trusted Patty, I left everything in her hands and didn't pay much attention to it after that. I felt like I had a daughter looking after me. In 1981, my son John considered a career move to Los Angeles. After some discussion, we decided to sell the house because I just didn't want to live there by myself. It was a little too remote in the Berkeley Hills, and since I didn't drive, besides, the house had tripled in value. We finally sold it in October 1982 and received $160,000. This was more money than I had ever seen in my life. Once Patty invested it for me, It would give me substantially more income to live on. And being a retired library assistant, I could really use the additional income. All I had was Social Security, a small pension, and my investment with Patty. As a temporary measure after the house was sold, I set myself up in a small rental apartment in Santa Cruz. It took some time to get used to such a small place, but I really thought it would only be temporary. It never occurred to me that all the mail I was receiving from Patty's office meant there might be something wrong. I assumed it meant she was working on my behalf.
When Anita came to me at the urging of a friend, she was having trouble understanding her statements. When I looked at Anita's statements, I was shocked to discover that she had no money left at all. How was I going to tell her that? By sifting through the statements, I determined that hundreds of trades had been made in Anita's account. Her broker had been buying options, one of the riskiest investments anyone can make. 90% of all people who buy them lose all their money. How was it possible that this brokerage firm had allowed Anita to invest in options? You see, all firms have strict financial requirements that clients must meet before entering into risky investments. I knew Anita didn't qualify, so I had her request all the original paperwork she had signed to open up the account. All the figures that gave Anita's net worth were dramatically inflated so she could qualify to buy options. Patty overstated the figures by $250,000. Since the forms were signed by Anita before they were included, the brokerage firm and Anita had no way of knowing the figures had been fabricated. When I grasped what had happened, we sued the firm and went to arbitration. 2 years later, after all the miscellaneous fees and lawyer bills were paid, Anita had recouped only $50,000 of her losses, a far cry from her original $160,000. If her investments had been prudently made, even if she had simply left her money in a high-interest money market fund, she would have been $100,000 ahead. Instead of having $50,000 to her name, Anita would have had $270,000. Her old age would have been safe and secure. Today, at 74, Anita lives on an income of $1,100 per month. With fixed expenses of $900 per month, how different is her life now?
To go to the airport, I take 4 buses and a train. It only costs $3 to $4 with my senior discounts, but it takes 5 hours. A cab costs $40. I do all my shopping in thrift shops. I never go to a department store to buy anything new. Ever.
Anita's mistakes are ones we can all learn from. To begin with, she signed blank papers she hadn't read or understood, an invitation to disaster. But she made a more basic error. She was tricked by an advertising campaign and an unscrupulous broker's warm smile and reassuring manner. She passively signed the papers and checked out of the picture. Don't you be taken in. So here's the strategy. Seek out advisors who come personally recommended. You find your doctor through others who have been there. You have even decided on a favorite supermarket because it has the best quality and prices. How do you know these things? Comparison shopping. You've checked them out, or they have been recommended by others. So why would you select someone you know nothing about to invest your money? You would not, but most of you do. So wake up and avoid the guardian angel syndrome. Just take a few simple steps to find the best financial advisor. If you discipline yourself today to take time and prepare, what happened to Anita will not happen to you. To begin with, both you and your spouse or significant other should address some basic issues. First, clarify your goals. Do you want to travel, sell your house and buy a mobile home, buy a new car, redo your kitchen or replace your roof? Maybe you want to play golf every day or stay home with your hobbies. Whatever the case, write down all your goals, both immediate and future. Then, think about your emotional attitude towards your money. For instance, Imagine yourself investing part of your money in stocks, which fluctuate in value. Let's say your stocks are moving downward. How would you respond? Would you anxiously check the newspaper every day for stock values and lose sleep? Or do you respond differently by accepting the consequences of a risk you decided to take? It is your job to know which investments will make you comfortable and which will drive you nuts. If you're losing sleep over any of your investments, no matter how good you think they are, believe me, it ain't worth it. Put your feelers out for a financial advisor. You can ask friends or relatives whose opinions you respect if they can recommend anyone. Or you can call the Human Resources Department where you worked and ask if they have the name of an advisor with whom other retirees are satisfied. For further information, you can consult the organizations listed in the resources section of the booklet that accompanies this tape. If you call a brokerage firm you've selected on your own, as Anita did, make sure that the firm you deal with is a member of the National Association of Securities Dealers, as well as the Securities Investor Protection Corporation. When you call the firm, ask to speak with the office manager. When you get him, tell the manager that you're retired and want an advisor who has been in the industry for at least 10 years and specializes in retirement planning. This way you know they have dealt with different economic environments and hopefully understand your needs. Don't just walk into a brokerage firm and ask for a broker. If you do, I'm telling you, you will be assigned to the new kid on the block. Now you're ready to interview financial advisors. Remember to keep a number of things in mind for these meetings. First, if you are a couple, both husband and wife should be present for the interview. The advisor you select should make both of you feel at ease, especially the woman. Odds are that she'll outlive her male counterpart. So listen up, ladies. You better be ready to pick up the financial reins when the time comes. Remember, you're comparison shopping. You'll want to interview at least one person at 3 different firms. Start by checking business cards. See whether the advisor has a title after his or her name. Go with someone who has at least a vice president of investments, and work up from there. This title indicates the advisor's earning power and how long he or she has been in the business. Avoid using advisors with titles like account executive, financial advisor, or financial planner. These are the marks of the new kids on the block. And there are other things to consider. Let's play detective. See whether the advisor is a certified financial planner or CFP. That's what you're looking for. If so, his or her business card will say it. Then what do? You should also ask to see the certificate itself, because you never know if the business card is legit. The CFP indicates that the person you're talking to has studied for 2 years, has been through extensive tests, and has to take a minimum of 30 hours of continuing education each and every year to keep up to date. You'll want some sense of the advisor's stability as a worker. So ask them how long they've been with this firm. They should reply a minimum of 4 or 5 years. If they haven't been there that long, ask them how many prior companies have they worked for. Again, look for an answer of no more than 2. Then ask how long they've worked at the last firm they were at. An answer of no less than 5 years at the most recent firm is what you want to hear. You're looking for stability. If the person has been at many firms for brief durations, this is not stability. During the interview itself, you should be asked about your goals. If the advisor doesn't ask you, you may be dealing with someone who cares more about the commissions they can get from you rather than the good they can do for you. But the central question for you to ask is this one. How does your potential advisor make his or her money? They won't volunteer this information, so it's only by asking that you'll learn about it. And believe me, this is going to make them squirm. Still, you've got to work up the nerve and ask anyway. A little discomfort now beats a lot of grief later. So just remember that there are only 3 possibilities on the table. They either make money by commission only, or by fee plus commission, or by fee only. Fee-only planners can charge dearly for an original plan, But since they don't implement this plan for you, they are generally more impartial and are likely to give better advice than the others. Fee plus commission planners charge a small upfront fee for the plan and receive commissions on the investments made. So who knows if this financial plan is good or not? And a commission-only advisor, which most of you use, makes money whether you buy or sell anything. Remember, when commissions are involved, planners can and will steer you towards high commissioned investments that will be beneficial to them, but not necessarily to you. That is why, of these three choices, fee-only planners are the way to go. They have nothing to gain from the advice they give you. But there is another alternative out there that very few people know about, and this one is my favorite. The Registered Investment Advisor, or RIA. These advisors receive as their fee a fixed percentage of the portfolios they manage. It's about 1% a year of the money you give them. So what's the advantage of signing on with a registered investment advisor? You see, first of all, not only do they tell you what to do with your money, they do it for you. And second, registered investment advisors are in the unique position of being on the same side of the fence as you. The more money they make for you, the more money they make for themselves. Although most registered investment advisors do not partake in commissions, that doesn't mean there is no cost to you to buy or sell financial securities. So you'll want a registered investment advisor who will hold your funds at a discount brokerage house such as Charles Schwab or Fidelity. So sells and buys on your account will cost you less. It's possible that the registered investment advisor has a discounting arrangement elsewhere that you can take advantage of, but make sure you ask. It is to their benefit to keep costs down, because if you spend a lot of money on commissions, there will be less in your account to base his or her fees on. These fees, by the way, should be paid quarterly, not upfront. But be aware that many registered investment advisors require a minimum amount to open an account, starting at $50,000 to $100,000. But shop around. There are some out there for as little as $10,000. Here's a tip. Look for a registered investment advisor who charges no more than 2% annually, including costs to buy or sell any of your investments. And here's a rule of thumb that is especially important to keep in mind when dealing with a registered investment advisor or any financial advisor. Read the contract carefully. It should include the fee payment schedule. Make sure you have the right to fire your advisor at any time you choose, and if you ever become unhappy with his or her performance, you have the right to fire your advisor and still keep the funds at the same brokerage firm if you choose. The registered investment advisor can also terminate the contract. So make certain, however, that the fees are prorated under these circumstances. That is, you don't want to pay for services you don't continue to receive. And make sure you receive a minimum of quarterly reports on how your money is doing from your registered investment advisor. This is in addition to monthly statements from the brokerage firm. No matter which kind of financial advisor you choose, keep these basic principles in mind. Feel comfortable with your advisor's knowledge and with the stability of his or her firm. Read all documents thoroughly before you sign them. Ask about anything that isn't crystal clear to you. Verify the accuracy of all the information the advisor has given you, and make sure they are not hiding any information about their involvement in disciplinary actions or criminal investigations. You need to check this by writing to the NASD Public Disclosure Program, whose address appears in the resource section of the booklet. And finally, it is good to ask a potential advisor for 10 references with addresses and phone numbers. Make sure that you call each and every one on the list to see how successful this advisor has been with other people's money. The proof of this pudding is in the earning. Okay, once you understand what is going to be done with your money and have chosen a particular advisor, it's time to open an investment account. This is where Anita made her big mistake. So listen up here. First, never sign blank documents. The firm's only way to monitor its advisors is by using the financial information you provide and approve by signature. In Anita's case, she had only $10,000 when she opened the account with Patty. But what did she do? She signed blank documents enabling Patty to falsify Anita's financial information. Second, get everything in writing on the company's letterhead. Don't accept verbal promises. Don't sign anything until you have everything you want and have it in writing. Third, don't sign a discretionary account form that allows anyone other than a registered investment advisor to do anything he or she wants with your money. This is particularly true if your advisor works on commission. And finally, make certain that you request and receive copies of all original documents. Keep everything we've talked about in your file. In case anything goes wrong and you need to make a formal complaint, all the information you need will be on hand. Once you've done all these things, from hiring an advisor to opening an account, one last step. You must continue to monitor your advisor very carefully. To do this, you have to learn to read your statements and know what is being done with your money. Your advisor should offer to teach you. Don't be afraid to ask, and don't take no for an answer. If your advisor is resistant, you can always transfer your account elsewhere. Compare your statements from month to month. Keep track of whether your account total is going up or down. If it is going down, find out why immediately. And be aware that every time a trade is made on your behalf, you must be called beforehand for your approval. Nothing should ever be bought or sold without your explicit approval. If you don't understand what your advisor wants to do with your money, just don't do it. Remember the old adage, better safe than sorry. In general, pay attention to all the information you receive, ignore nothing, and don't be afraid to question anything. Never talk yourself into trusting someone. Remember, this is your money. Always stay knowledgeable about it. There is a difference between letting someone invest your money and letting someone control your money. What happens to your money will directly affect the quality of your life. The more you keep on top of your money and your advisor, the less likely that Anita's fate will be yours. Most of us assume that we'll pass on our property through a will. We don't take time to think about more efficient methods for ensuring that our loved ones will receive the inheritance that we want them to have. Here I want to introduce you to something that is a must for each and every one of you, a trust. Chances are that your lawyer won't tell you about its advantages, but Marcia's story is a dramatic illustration of why a trust is almost always preferable to a will.
I'm 64 now, and I still have such fond memories of growing up in Connecticut. My parents' house sat on 1.5 acres of land that were dark green and fragrant in the summer and picture postcard white in winter. The house was 150 years old then, and every room was filled with precious antiques, each reminding us of a story about some family member. When I grew up, I moved away and bought a house out in California, never losing sight of returning one day. It was when Father died and Mother became ill that I rented my house and moved back to take care of her. When she finally died, I knew I wanted to remain in the house. Because I was an only child, it was always assumed that everything would be mine someday. I would live out my years there, surrounded by our family heritage. It had given Mother such comfort knowing I would be financially secure. Of course, no one ever thought there was anything to worry about. Mother and Father had made out a will. They thought they had done everything they were supposed to do to protect me. It never dawned on them that with only a will, I would have to pay hundreds of thousands of dollars to keep what was really already mine. The process of settling the estate began right after Mother's death. We had realtors appraise the house and land and submitted that figure to the IRS. Months later, the IRS came back and assigned a considerably higher value. They appraised the land and the house, along with the antiques, at $1.2 million. I challenged the IRS appraisal, but they stuck firm. The IRS based their estimate on recorded sales of surrounding homes, most of which were much newer or had been modernized. They never even took a look at my house. The last time our house was renovated was in the 1940s. I cook in a 1940s kitchen. The house has a 60-watt electrical system and only one bathroom. Goodness, there's still a dirt basement. So when they told me I now owe $235,000 in estate taxes, I nearly fainted. Where was I going to get that much money? Mother just had the house and the property. There was no cash to speak of. The IRS already allowed a 6-month extension to pay the money. They said I would not have to pay a penalty, but I would have to pay interest. I didn't know what I was going to do. Now we were only a few months away from this deadline, and the IRS was not going to allow us any more extensions. I talked to just about everyone I could think of, looking for help. One suggestion was to divide the land into lots and sell off some of the lots to pay the tax. But it would have taken time to do that, and I didn't have much time left. So my lawyer suggested that my only alternative was to take out a bank loan. At that time, with interest rates so high, the best I could do was a 12% loan that had to be paid back in 2 years. Because I had no income, I had to borrow an extra $100,000 to pay the payments on the loan. The bank used the house and the land as collateral. I knew that if I took this loan, I would definitely have to sell off the land to pay back the bank within the next 2 years, or I would lose everything. What choice did I have? So I borrowed $335,000. As soon as the loan cleared and the IRS was paid, I began the process of subdividing the land into 6 lots and trying to sell them myself. By the time I put them on the market, property values began to drop dramatically, and the lots just weren't selling for my asking price of $110,000 each. The highest anyone was willing to pay was $65,000 per lot. That was $45,000 less per lot than the IRS valued them at, and I paid estate taxes on. I felt so pressured because my 2 years on the loan were almost up. I had to sell quickly to pay back the loan, so I took the offers, leaving me little to live on. Since it was obvious that I was going to need money, I sold my house in California. Today I receive about $4,000 a year in interest from the money I received when I sold my home in California, along with my Social Security of $8,000 a year, giving me a total of $12,000 a year to live on. My expenses for my health insurance alone are $4,000 a year. The property taxes are $5,000 a year. That leaves me only $3,000 to pay for everything else: food, electricity, telephone, clothes, and such. I always have a sense of anxiety about spending any money. Sure, I could sell the house for money to live on, but how do you sell your heritage? I can't.
Marcia's mother never had any idea that her daughter would face such problems, because everything passed to her quickly and smoothly when her husband died. Why? To put it simply, property passes from husband to wife differently than it does from parent to child. Between spouses, there is never a question of estate tax. Had Marcia's parents foreseen their daughter's difficulties, they would have done estate tax planning and set up a marital trust, who now hold as joint tenants with the right of survivorship. If you die without facing any serious difficulties, then your gamble pays off. But try this one on for size. While you're still hearty and healthy, your daughter has a traffic accident in which she critically injures a motorcyclist. The victim's lawyer finds your child's name on your bank account, and guess what? The moment you signed that account over to your daughter, it became half hers, and there goes your money. So while it's tried and true, this method of passing on property offers little in the way of protecting you in case the unthinkable happens. Fine, you say. You won't take the chance by setting things up in joint tenancy. You'll just give your estate to your children. But beware the gift, my friends. Why? Say you give the house that you still live in to your son. Something awful happens, that unthinkable something again. He dies before you. In his will, he leaves you all his property, including your house. Irony of ironies. You may have to fork over thousands of dollars in probate fees just to get your property back. So I've said it before, and I'll say it again. For most of you, if you really want to give your family a gift, give them a trust. Under any circumstances, it is extremely difficult to lose someone you love, but it is also inevitable. It will happen to all of us. Here, I want to talk about durable power of attorney for health care, a way of restoring dignity and control in the face of a loved one's terminal illness. Let's hear Barbara's story, a convincing example of why you need a durable power of attorney for health care.
To give you some background, John had been ill with coronary heart disease for 14 years before his death. He had had his first bypass surgery 11 years earlier. Because of severe arterial degeneration, he needed a second surgery. But something inside John told him not to expect to survive this one. He even commented that he didn't want to be on a respirator or life-saving machines if anything went wrong with the surgery. We finally agreed, as a precaution, to have John sign the durable power of attorney for health care papers we had tucked away in the drawer. We would do this before the weekend was over because his surgery was Monday morning. On Saturday, I went to the supermarket to shop for our annual Father's Day family barbecue. When I returned several hours later, I saw John slumped over in his chair with the TV still on. My God, I knew he was dead, but I didn't know what else to do, so I called 911. He wasn't breathing and was even purple from lack of oxygen when the paramedics arrived. They worked to resuscitate him because his body was still somewhat warm. After half an hour of this, his heart started. While John was being transported by ambulance, they lost and revived him another time. So when we got to the hospital, I found the doctors and asked that John not be put on life support. But I was too late. By the time we arrived, they had already hooked him up. I was powerless to take him off the machines because we didn't have the durable power of attorney for health care. There was a 3-day waiting period before they would test for brain activity. John showed none, only minimal brain stem activity that helped pump his heart, but that was all. With the aid of our attorney, Janet, the neurologist at the hospital agreed that the situation was hopeless. Fortunately, the doctor didn't believe in unnecessarily keeping people alive mechanically. Now the worst part was about to begin. Taking someone off life support is far more difficult than putting that person on. The machines aren't turned off all at once. It's done little by little, one machine at a time over an 8-hour period. You just have to sit there and watch this person you love leave you slowly.
What is this durable power of attorney for health care that Barbara's talking about? Simply, it's a document created while you are still capable of expressing your desires regarding medical treatment and life support. It gives someone you designate the authority to take you off life support if there is no hope you will ever live without it, or to make other health care decisions if you are unable to make them yourself. If you do not have this in writing, it would be virtually impossible to take your loved one off any life support system, even if this is what that person would have wanted. We've all given some thought to this situation, but how many of us have acted on it? If John had been conscious, he would have had the right to decide if he wanted to terminate any medical treatment, including life support systems, but he was not. There was no way for anyone at the hospital to know what his desires were without a written document with those wishes clearly stated. Several well-publicized judicial decisions have determined two things. A, there is such a thing as a right to die. But B, you can't exercise this right unless you put your wishes in writing. To eliminate any confusion regarding your wishes concerning life support, the Trauma Foundation in San Francisco has drawn up the following 3 choices for the durable power of attorney for health care, of which you can choose only one. Number 1, I want my life to be prolonged as long as possible, without regard to my condition, my chances for recovery, or the cost of the procedures. Number 2, I want life-sustaining treatment to be provided unless I am in a coma or persistent vegetative state, which 2 doctors, including my attending physician, reasonably conclude in writing to be irreversible. If my doctors have reached this conclusion, I do not want life-sustaining treatment to be provided or continued. And number 3, I do not want my life to be artificially or forcibly prolonged, unless there is some hope that both my physical and mental health may be restored. And I do not want life-sustaining treatment to be provided or continued if the burdens of the treatment outweigh the expected benefits. I want my agent to consider the relief of suffering and the quality of the possible extension of my life in making decisions concerning life-sustaining treatment. At all times, my dignity shall be maintained. So these are the choices, my friends. But when you become incapacitated and cannot make any decisions, you leave the responsibility to someone else to choose for you. This person or your agent is legally known as your attorney in fact. The responsibility is tremendous, so that person should be someone whose judgment you trust. No matter how specific you try to be in the durable power of attorney for health care, since no one can foresee the actual circumstances under which it is to be used, a fair amount of discretion will have to be exercised by this person. You will want someone who is most philosophically aligned with your position. Ask yourself, who knows you best and will agree with what you want? Will that person be able to act intelligently and according to your wishes when the time comes? The person you choose to be your agent should love you and care about you. But he or she must be strong enough to follow your wishes. Be sure you discuss your wishes with your agent well in advance of any life-threatening situation. If you have particular religious convictions or a spiritual bent, your beliefs should be reflected in your choice of an agent. It is better to have someone as your agent who lives no more than a day's travel away. It is best to designate one person as the primary agent or attorney in fact, and always name alternate agents as well. At least 3 people should be named. If something happens to the first person named, you then have a second choice and even a third choice. You can always amend a durable power of attorney for health care in the event of a death or change in a relationship. There are possible glitches that can be predicted. In families, not everyone may agree with your wishes. Even if one child agrees with you and is your agent, another child may defy the order even though he or she may not be your agent. That person can go to the court to try to stop the proceedings, alleging that you did not know what you were doing when you signed the papers. If after talking to all your family members, you still sense that there may be a difficult situation, make sure your durable power of attorney for health care states, I want the wishes of my agent to be respected regardless of the contrary wishes or intentions of other members of my family. Be clear about what you want, and make certain your doctor and the hospital will honor your wishes. To assure this, you must have your wishes accurately written in the proper format. Most states have enacted legislation that prescribes the format of the durable power of attorney for health care. Forms can be obtained at most hospitals or public health services in your area. They may even have someone on staff to help you fill out the form. Fill it out sooner rather than later. Barbara and John put off signing the form, and Barbara found out the hard way that unless you have your wishes in writing, the doctors do not have to abide by them. Unless there is a durable power of attorney for health care in writing, doctors and hospitals will protect themselves even at emotional and financial cost to you. And why risk not having a durable power of attorney for health care? It's not expensive. In fact, in most hospitals, it's absolutely free. And if you are going to set up a trust with an attorney, the durable power of attorney for health care should be included in the overall price of the work. Remember to keep the completed document with whomever you have chosen to act as your agent. Additional copies should be made for your personal physician, HMO, or health insurance company and be kept as part of your medical records file. This will be helpful in circumstances when you are away from home, like a vacation. When your insurance plan or physician is contacted in case of an injury, they will let it be known that you have a durable power of attorney for health care. For security purposes, always carry the name of your doctor, HMO, or insurance company in your wallet or purse. Now, you should keep in mind, however, basic distinctions. The terminology in this area can get a little confusing, to say the least. A power of attorney is not the same as a durable power of attorney for health care. A power of attorney simply has to do with asset management and the ability to change and take control of those assets. The durable power of attorney for health care deals only with health care issues. Also, don't confuse a living will with a durable power of attorney for health care. A living will expresses your general wishes about critical care. It does not authorize anyone to act on your behalf to make decisions. A living will is interpreted by the doctors merely as a directive. A directive, or advance directive, does not give them the power to unplug you. In other words, a living will does not handle this matter as efficiently and effectively as a durable power of attorney for health care. The durable power of attorney for health care may be the most important document you will have because it affects you directly. A will and a trust deal only with money matters after you're gone. This document deals with your life. Learn from Barbara and John's dilemma. You know, I asked Barbara why John hadn't signed the durable power of attorney for health care over the 11 years he knew he was seriously ill. And this is what she told me.
He just couldn't bring himself to face his own death, and signing a paper like this made his mortality seem too real. This may be one of the hardest things you will ever have to do, but that shouldn't stop you from doing it.
Nothing is more preventable than the swift and total financial devastation that comes from a long-term care stay. That is why I consider the following discussion the most important on this tape. If you don't prepare for the possibility of a nursing home stay, chances are you will be wiped out financially in a matter of months. Here, I'll use my own experience to illustrate the necessity of knowing what to do before it's too late. Early in my career as a financial advisor, I decided to specialize in retirement planning to make sure that when my clients no longer wanted or were able to work, that they would have the funds needed to sustain them throughout their old age. I also wanted to make sure that if they became ill, they'd have enough money to stay out of a nursing home. You know, I was quite adamant that no client of mine would ever end up that way. But in my role as a financial advisor, I made a discovery. People don't end up in nursing homes because they have no money. They have no money because they end up in nursing homes. It wasn't until I met my clients, Bernice and Conrad, that I saw firsthand how a long-term care stay can ruin the lives in a family. When this pleasant, soft-spoken couple came to me, I thought they had the perfect financial situation for retirement. Their monthly expenses of $3,000 were covered by their pension and their retirement account, which I invested partly for growth and partly to generate this income. Bernice and Conrad were several years away from receiving Social Security, so I also set up a mortgage program so that they'd complete their house payments by the time their Social Security started. This, along with the money invested for growth, would be their hedge against inflation and illness. With the house paid off, their expenses would go down. Their income would then increase even more when Social Security began. I thought that if anything happened to them, their extra income would take care of it. This was an ideal plan, or so I thought. Everything went according to schedule until a year and a half after Conrad retired. He had a stroke. Bernice tried her best to keep Conrad at home, but she just could not care for him physically, especially when the in-home help she hired wasn't reliable. 6 months later, he ended up in a nursing home at a cost that equaled all their monthly income, $3,000 a month. All of it went to Conrad's care. To survive, Bernice had no choice but to start taking principal from the invested retirement money. Within 3 years, their retirement account was wiped out. Shortly afterward, Conrad died. Bernice still receives a $2,000 a month pension, but still falls far short of the $1,000 needed each month to meet her own expenses. That's the kind of shortfall you just can't live with. The lesson of Bernice and Conrad's story is hard to learn, but it's this. Odds are that at some point, 1 in 3 of us will spend some time in a nursing home after the age of 65. Your regular health insurance won't cover it. Medicare won't cover it. So the best and most affordable protection for your retirement may be long-term care or LTC insurance. When I first learned about LTC insurance back in 1988, the policies were short-sighted, not even worth the paper they were written on. In just about every case, the only benefits from LTC policies were to the insurance companies who issued them. Today, however, that's no longer true. LTC insurance provides the protection needed for older Americans. It is one of the most important parts of any retirement plan. Maybe you're thinking that you don't need LTC insurance, that you'll beat the odds and never darken the door of a nursing home. But if you want to make this kind of bet, you better roll the dice right, because you can't afford to be wrong. Depending on the amount of care provided in your locale, the cost of care in a nursing home can average between $30,000 to $100,000 a year and is increasing. In-home service costs can vary even more greatly, depending on what is needed, how long it is needed, and who provides the service. Estimates range from $8,500 to $70,000 a year. Unfortunately, most of you will pay for this care from your savings, the money you have worked for and saved during your lifetime. Until things change dramatically, most people will turn to their families, the traditional source of care when something goes wrong. It has been well documented that families provide some 70 to 80% of all home health care and long-term care for older family members. But few families today are prepared financially and emotionally to maintain this intensive level of support for an extended period of time. Everyone in the family is affected, but the major burden rests on women, who may be raising children and working at the same time as caring for elderly parents. Besides the emotional drain, families can exhaust their financial resources when caring for a family member. And when that happens, Medicaid takes over. And by then, you're financially destitute. But by planning for your long-term care needs now, you can protect yourself and your family from financial disaster. Buying an LTC insurance policy can be somewhat confusing to say the least. But with a little caution and attention to detail, the following guidelines will help you enormously. For instance, you'll want to know the daily benefit of the policy. This is the amount of money your plan will pay for eligible care. Policies generally offer $50 to $240 a day for nursing care and $40 to $150 a day for home health care. But remember that the average cost of nursing care is $100 a day or $36,000 annually. If you want to buy a plan that will cover all your costs, consider buying a daily benefit of $100. Next, check the benefit period, the length of time your plan will pay benefits. The average nursing care stay is 2.9 years. If you are between the ages of 45 and 64, consider selecting a 4-year to lifetime benefit. If you are older than 64, choosing a 4 to 6-year option may be adequate. The final choice, however, will depend on how much you can afford to pay in premiums. Premiums will be higher for a longer benefit period. When purchasing a plan, always check for the inflation option provision. With this provision, your daily benefit increases a certain percentage each year to help keep pace with rising long-term care costs. This will be one of the most important decisions you will make regarding an LTC insurance plan. The younger you are when you purchase the plan, the more time there is for the daily benefit to grow. You can consult Note 1 in the booklet to see how this works. You should also look for the elimination period, something similar to a deductible in your major medical health insurance plan. This is the time period during initial confinement for which you receive no paid benefits. These periods typically run from 0 to 90 days. Always consider buying the shortest possible elimination period you can afford to protect your assets and estate adequately. If a 0-day elimination period is offered and the price difference is insignificant, don't hesitate. Take it. Many companies offer a rider to their plans called a non-forfeiture benefit. This indicates that if you do not use the benefits of your plan after a certain number of years, you or your beneficiaries can get back a portion of the money paid in premiums. Don't be fooled, though, into believing this is easy money. It looks attractive, but beware that the premium cost is usually about 35% higher for this rider. If you can afford the extra 35% and are disciplined, take that amount and invest it for growth. Ultimately, you will come out ahead. There is a trend towards providing more care at home. So home health care benefits cover the type of care you receive in your home from a therapist or a homemaker or chore worker. And since most people prefer being cared for in their homes, coverage for home health care is advantageous. The costs vary depending on the type of care needed, who provides the care, and for how long. A home health care benefit that covers at least a 2-year period of time is recommended. Whether to consider more or less coverage will depend on other aspects of your plan. Some states require the purchase of a minimum home benefit tied to the length of the benefit you choose for long-term care coverage. Be sure to check this proviso in your state. Many companies allow for flexibility when considering where you may receive care. With an alternative plan for care option, if you, your healthcare provider, and the insurance company all agree, you may choose to receive your care in a nursing facility, at home, or in another care setting. Look for policies that offer and mention these provisions so you can be prepared to meet any future needs in a way that allows you as many options as possible. Many companies also offer a 10 to 15% spousal discount. If you and your spouse are considering LTC policies, look for a policy that offers this discount. Now, LTC insurance is only good if it pays you benefits when you need them. So insurance companies set up gatekeepers or qualifiers that must be met before your policy can pay off. The most common gatekeepers are these. 1. Medical necessity. This is where a physician says that you need the care and requests that you receive it. Simple as that. 2. Your failure to perform 2 out of the 7 activities of daily living, or better known as ADLs. ADLs are walking, bathing, feeding, dressing, transferring, being continent, and going to the toilet. If you can't do 2 out of the 7, the policy pays. And third, cognitive impairment. This is where you need supervision to take care of yourself, as with Alzheimer's disease. Look for a company that offers all 3 of these gatekeepers and find a plan in which meeting any one of them will allow you to qualify to receive your benefits. Ask to see a specimen policy that defines the gatekeepers as well as the activities of daily living. Definitions for qualification vary from company to company. Now, the premium will be the amount you pay for your policy. It will depend on which insurance company you choose, which are the previous options you select, and your age and health at the time of purchase. You should be given a choice as to how you would like to pay your premiums: monthly, quarterly, semi-annually, or annually. Try to pay on an annual basis. You see, most companies charge you more if you pay any other way. Calculate which way is most advantageous to you. And be sure to find out whether the policy you are planning to purchase is a group or an individual policy. There are significant differences between the two. In an individual plan, the insurance company has a written contract between you, the insured or policyholder, and them. You will receive a copy of the policy, and the company cannot make any changes to this policy without your consent. In a group plan, however, the insurance company agrees to provide you, the insured, with coverage and lists you on a certificate of insurance you will receive. The policyholder, however, is a third party, your employer, a consumer group or association. Thus, the insurance company and the policyholder can agree to changes in the policy or contract, or even cancel the policy without your approval. Your certificate of insurance summarizes the important provisions in the contract. This certificate, however, is not the contract. Most employers offer group plans for ease of administration. With most of these group plans, there is little flexibility in benefits provided. They have longer elimination periods, limited benefit periods, poor inflation protection, no spousal discounts, and depending on the state, some are not guaranteed renewable. If you are offered a group plan by your employer or association, check out the cost and benefits of an individual plan before making any decisions. Many people believe that group insurance premiums are cheaper and therefore a better buy. This, my dear friends, may not always be the case. There are many excellent individual plans available at equivalent prices and with superior coverage options. If you do purchase a group plan, make sure it can be converted into an individual plan should you leave the group. And you should make sure that your plan is guaranteed renewable. That is, the insurance company should agree to insure you for life, as long as you pay the premium within the agreed-upon time frame. Purchase only a plan that is guaranteed renewable every year for the rest of your life. This is especially important if you buy a group plan. Look at Note 1 in the booklet again. What should be clear to you from this is that the younger you are when you purchase LTC insurance, the more reasonable the premiums. An important point to remember, your premiums are not supposed to change as you age. If you buy it for $1,800 a year at the age of 60, hopefully that's the price forever. I say hopefully because with most LTC policies, there can be a change in what you pay if there is an across-the-board increase for all the insured parties within the state, region, or county who have your particular plan. So they just can't ding you unless everyone gets dinged. And keep this in mind too. If and when you use the benefits of certain LTC policies, your premium payments will cease. So as in the case of selecting a good advisor or lawyer, you have to choose a reputable insurer. Check for their experience and track record in paying claims. In the resources section of the booklet, I've listed the names, telephone numbers, and acceptable ratings of services that evaluate insurance companies. In Note 2 in the booklet, you'll also find a checklist that will help you to look for a plan that has the features you'll want. As I said in the beginning of this discussion, this is one of the most important concerns of your retirement. The more quickly you confront it, the faster you'll put to rest one of the largest worries you'll have. Remember, in an LTC policy, you'll pay less over the entire period that you pay premiums than you'd shell out for just 1 year in a nursing home. So start preparing now and protect yourself.